how to use straddle strategies, call put spreads, and butterflies. A bull call spread, or bull call vertical spread, is created by buying a call and simultaneously selling another call with a higher strike price and the same expiration. The spread is profitable if the underlying asset increases in price, but the upside is limited due to the short call strike. The benefit, however, is that selling the higher strike call reduces the cost of buying the lower one. Similarly, a bear put spread, or bear put vertical spread, involves buying a put and selling a second put with a lower strike and the same expiration. If you buy and sell options with different expirations, it is known as a calendar spread or time spread. A butterfly consists of options at 3 strikes, equally spaced apart, where all options are the same type, either all calls or all puts, and have the same time expiration. In a long butterfly, the middle strike option is sold and the outside strikes are brought in, a ratio of 1 to 1. Buy one, sell two, buy one. If this ratio does not hold, it is not a butterfly. The outside strikes are commonly referred to as the wings of the butterfly, and the inside strike as the body. The value of a butterfly can never fall below 0. An example of a butterfly would be to go long on a 70 call, short 275 calls, and a long 80 call. The identical spread could also be made with long the 70 put, short 275 puts, and long an 80 put. Being long a butterfly profits from a quiet market. Similar to a butterfly are the condor, iron butterfly, and iron condor. The butterfly gets its name from the shape of its profits and loss graph. We addressed briefly how a synthetic position in the underlying can be created from options. Combining options positions with the underlying can also produce synthetic options. This has to do with what is known as put-call parity, where call price minus put price equals underlying price minus strike price. Rearranging this equation, we can create a synthetic long call for a given strike price by buying a put and also buying the underlying. Similarly, a synthetic put is a long call combined with going short the underlying. You can also create other combination strategies that include a trade in the underlying, such as a collar or risk reversal.